Hello, YouTube. This weekend, we're going to talk about how the stock market is ignoring a red alert and how we are setting up a situation where the stock market wants to fight the Fed. This is generally going to lead to bad outcomes. And this weekend, we're going to try to do our best to outline the thesis and the reasons why we really need to be prepared for this next week ahead. So, in about 1 minute, I will try to explain what is going on here. The 2 and 10 year notes, which are the 2 year and 10 year Treasury notes from the federal government, hit a new high of 1.17%, which means that we're seeing yield curve inversion we have not seen ever. It's up another 8% on the week. We also have the 2 year note up by 9% today, almost recouping all of its losses. And right around its relative high here on the daily chart, we are now within kissing distance to getting to that roughly 3.4%. And the 10 year note is also rising, but not quite as much, which means that we are currently expecting short-term interest rates to go up. And the reason for that is because we had a blowout number on Friday for non-farm payrolls. Came in with 500,000 jobs. It did more than 100% of what we were expecting. Previous number revised up. And we had the unemployment rate also revised down, which means that this labor market is red hot. And the market did not do what we would have expected. Again, the S&P closed down marginally by 0.17%. The dollar closed up by about 0.8%. But the bond market has been leading the Fed, and the bond market is flashing a red alert right now. When the 2 and 10 year notes invert, it usually leads to recession within 12 to 18 months. So it does not mean we're going to have this go off tomorrow. But as the market continues to discount what the Fed is saying, they are losing credibility. And there were 4 or 5 different speakers this week which were trying to say that we're not currently at the neutral rate, which means that we're probably going to be getting some more interest rate hikes. And we have to start looking at what that would look like on the tape and what key catalysts could drive that. There is one catalyst next week, which is going to be CPI coming out pre-market on Wednesday, which will be very important. So again, moving forward, what the market's basically doing is that leveling off of some inflation data is giving investors confidence to fight the Fed. So that's what's happening. That inflation print that comes in on Wednesday is going to be critical. Why? Well, because people are fighting the Fed, and we'll touch more on this a little bit later in the show. But that's just the reason why we are currently where we are. Also, really important to note that we're actually exactly in the middle here of the fear and greed, or another way to think of this would be overbought or oversold. So as we are completely right back flatlined in the middle during a period where the market basically goes nowhere, during the month of August and September, we generally see, again, seasonally, 0.6% and 0.7% for August and September. So the market is back to neutral. The fear and greed is back to neutral. We're right around a key pivot at 412 on SPY. We're noticing that generally we do go a little bit down in August and September, but don't really go anywhere. This is important because, as I mentioned before, we have CPI coming in on Wednesday, pre-market, but then on Thursday we have jobless claims, which will be very important as well. And then PPI, or the Producer Price Index, coming out on Thursday as well. So the PPI will be a clue for what CPI will look like this time next month. And there's only 3 key data points this week. Earnings are pretty much wrapped up. So we've climbed the wall of worry, and now there are going to be some things we have to pay attention to, and notably positioning. In terms of why we would be bullish or bearish this week, the bullish narrative is that we have the Fed pivot, we have a shallow recession, we're over the short-term moving average. The bearish case is that 454 is going to be an unpenetrable fortress, same as before. DXY and TNX breakout. So I just touched on TNX. I'm now going to touch on DXY briefly because it also closed above a key area for me. I'm watching 106.56, which goes back to our 1989 high, which would start to confirm that we're putting in a massive head and shoulders. The fact that we are continuing to poke above and currently above the 50 DMA tells me that potentially we're setting up a cup and handle where the dollar could start to go dramatically higher. I don't know, but we're starting to see a lot of data repeat like what we had in 1980s. And the dollar went as high as 165. That is dramatically higher than we are today. We note that on the weekly chart, we have a W forming, or a win. Generally means the chart wants to go higher. We have a golden cross, and we're back above resistance. We're also maintaining our daily uptrend, and we had a nice bounce off the 50 DMA. So this is also flashing a yellow sign to me, or a yellow alert. The red alert is still the continuation on the yield curve. So again, looking on a weekly perspective, we've now been up for 1, 2, 3, 4, 5, 6, 7 weeks in a row. This is not what the Fed wants to see. So we'll touch on this a little bit later in the show. And I think I got one more thing here to look at. So again, deep recession risk is still the bear potential here. That jobless number that came in on Friday means that a deep recession is probably not coming right now. Could come later, but as of right now, it looks like we're in a red hot labor market, which means there cannot be a recession if we are currently in a period where we have a tight labor market. Tara, there are reasonable alternatives. This one also got a pretty big notch in it this week with geopolitical tension, and the surprises for this week could be Taiwan. I'll mention what could happen here a little bit later, seeing some rhetoric get ratcheted up, and communication channels are being shut down, which is generally not good. CPI also coming out on Wednesday. So as we continue the show, let's go forward, and what I want to do is jump to the article shortly. But before that, I just want to look at a few more things here. So we'll look at some charts, and what I want to point out here is just that seasonally weak period means that, again, we're expecting to not really go much of anywhere. This is what would normally happen. This market is not normal, but it's starting to normalize. So we'll look at this in a second here. I also mentioned the fear and greed. So if we're perfectly back to neutral, where the bears and bulls are both equally positioned, this means that we were very bearish. We were down in single digits not that long ago, coming back up to neutral, which would mean that the bears could reposition here and, again, try to stomp the chart. On the flip side, people who are sitting in cash or who need to beat the market after the best month since 2020 need to return gains, which means they need to start leveraging up or buying more in order to beat the market. That's the reason why people hire money managers, is to make more than what you can do by just buying the index. So with these two things in mind, we're now going to look at the charts and just try to understand what's happening here. So I'm actually going to look at a monthly chart first because, again, that monthly seasonal image I just showed you shows us that we don't really go anywhere for the next 2 months. So if we don't really go anywhere for the next 2 months, that's technically bullish for me. But again, we're seeing some morning signs. And as I mentioned before, I am kind of noticing an inverse head and shoulders pattern setting up here where we're looking for potentially 2 to 3 candles on the left shoulder, which would repeat on the right shoulder. So we have a fairly tight range for the month so far, which is also the range for last week. We have a low of 406.82 and a high of 416, which is roughly a 10-point range. We're still perfectly, basically perfectly within the yellow box that I thought we would find the most trading range, and we're above last month's high. So last month's high is 413.03, and we closed above that, which means the incredible run that we had last week sustained, and we closed above last week's high and near the high of this week. So another way to think of this is by looking over here at SPY on the weekly chart. And here on the weekly chart, what I want to point out are 2 key areas here. I have them circled in yellow boxes, and there's a lot of lines on the chart now, which I will circle back on and touch on a little bit later. But as we look here, what do we have? We have these 2 yellow boxes. So what the yellow boxes signify to me is, again, a huge up week. Over here, we have a huge up week. And then what do we have? The following week, we have a red spinning top, or a doji. So what this means is that we had a huge move up. We closed below the high, and we have, again, an indecision week after a huge move. Ultimately, we do reject and have that big plunge. So it kind of looks like we're setting up the opposite here, where now we have that big up week. Again, similar to here, we have a big up week, but now we actually have, again, this is more of like a spinning top as well. The wicks are smaller though, but we closed above the candle high, like we did not over here. So over here we do, over here we do not. And now for this next week, what I would look for would be what? Well, if we're doing the opposite, here we have a slightly lower high. Over here, I would look for a slightly higher low, which would perfectly align with my uptrend we have drawn right here, the sharpest or most acute pink line. And if we hold that one, that could drive us up to the 50 DMA. The big question is, again, whether or not we're actually going to get a move. We could go sideways. Sideways would be fine too. But if we do get that powerful move up, I could see us going to 420, even up as high as 435, which is roughly our 200 weekly. Our 50 weekly and our 200 daily. 200 daily right now is at 432.73. So keeping that in mind, I think that there is a lot of potential. And that's the reason why I put red alert in the thumbnails, because people have to be really mindful that now is not the time for complacency. Whether you are bullish or bearish, the market is perfectly neutral, which means it's coiling up like a spring. As a spring coils up, when it releases, it has an explosive move. The explosive move could lead us to 430, if not back up to my ultimate target of 450, or it could also crash land all the way down to strong support at roughly 382. That's the really big takeaway here. So keeping all that in mind, I want to look at one more thing actually. So we have this falling wedge pattern here, which has been very reliable for me to get to here. What I do not know is where we go now. So looking at the falling wedge, we note that we fall out of the falling wedge, we back test, that's where we want to buy, and then we slingshot up. That's the same thing happened on SPY here. So here's our falling wedge identified by the blue lines. And then what do? Well, we break out, but we've not yet back tested. That's where the back test could actually be bullish. And there's lots of charts which have daily holes on them or daily gaps. Filling those gaps now would make it healthier as we advance. And there we go. Looking at QQQ, this chart is much more obvious because it's already done what I want. And the NASDAQ is currently leading. So keeping this in mind, again, I also added a Fibonacci retracement here. We can note that the red line is going to be a key level. The pink line here is going to represent a negative 30% contraction, which means 30% off the highs. The blue line signifies negative 20 off the highs. That is going to be the bear market, the start of it. What are we doing right now? We're butting up against the bear market level, the blue line here. And the green number here signifies the birth of a new bull market. We closed Thursday above 323.14, which means that technically we did birth a new bull market, and reclaiming it and getting above the blue line means that we're going to be expanding, getting out of bear market, continuing the bull market, and going higher. So the reason why this is important is because this is much more similar to our falling wedge breakout, backtest, and then advance. So it's right here, right? We got the falling wedge. It's very acute or very sharp. We ultimately break out, we backtest, and then we advance. So this pattern is very reliable to get to here. What I don't know is where we go next. Are we going to go up? Are we going to go down? Are we going to go flat? I don't know. So that's, again, no one knows everything. And the same thing here. We could fall all the way down to roughly 303. And that would actually be a bullish backtest where we coil up and then ultimately push higher into September. That September date is also very important because that is the next time the Fed is going to be talking. So I'm going to flip to the articles here in a moment, which will tell a story. But what I want to look at next is actually going to be the levels for this week. And as a reminder from last week, we had an invest alert or algo on SPY at 388. Where are we now? Well, we're at 413. So from 388, which was my incredible buy signal, now we have roughly a 7% rally. That's pretty good, straight up. So now the question is, what do we do from now? The notes tell us that, again, this invest algo or alert is going to be good for roughly 3 months. Is it a guarantee? No. But after doing backtesting, that is our ideal or, again, optimal holding period. We're currently in a kangaroo market. Again, you can see that here by my status being kangaroo. And what a kangaroo market means is that technically we are still in bear market, but a bull reversal is underway. And that's what's really hard to call right now. We're in a kangaroo. We could continue to go sideways. We could have a powerful move up, which means the bull reversal is confirmed, no longer underway. But this could also just be a big bear market bounce where we start fading back down. Again, CPI will be the catalyst this week. We can also note support and resistance here where the most important levels for me are going to be these weekly higher lows and the weekly higher high. So not to spend too much time on the levels here, encourage you to pause the slide if you want to read them. I'm just going to go back and explain the reasons why S3 and R2 are so important this week. The reason why they're so important is because, as I mentioned before, we have these yellow boxes. These yellow boxes pretty much tell me whether or not in the short term, meaning for next week or for the next candle, we are getting clues, not guarantees, but clues. We're going to go up or down. And as I mentioned with the spring before, this volume is really dropping off, which means it's coiling up. The coil is, the spring is coiling up, and eventually we will get a massive volume bar. Might not be all the way till September or October when we come back in Labor Day again. Sell in May and go away and come back on Labor Day. We normally don't see a lot of volume in the summer. But keeping in mind that if we do print a lower low this week, it means that we're invalidating the opposite of this move, where we get a lower high to confirm the move down. If we print a lower low, for me, that means that, well, we're invalidating the move up. And now if we think about the higher high, if we print a higher high, what that means is that after the incredible move that we had 2 weeks ago post the Fed, and an indecision week or digestion of the move, after closing above the high, we're ready for more, just like we were this week. So we climb the wall of worry more, we can continue to ride our uptrend, and that 50 weekly moving average becomes closer and closer in sight. And this will be very important because as we go through some of these articles coming up next, there are a lot of comparisons to 2008 and 2000. So I'll repeat myself one more time just to explain the emphasis on these levels. And every previous time, maybe not every single time, but almost like clockwork, if we lose the 50 moving average, we test the 200 moving average, and then we reclaim the 50, that leads to an expansion. So the blue line is going to signify the 50 moving average or the 50 weekly moving average. The black line will be the 200 weekly moving average. And what we want to look at is just where we are right now. So we lost the blue line, roughly tested the black line, and now we're trying to reclaim it. If we can reclaim this blue line, like I've said from the start of the bull market, from the bottom here, that is the confirmation for me that we're going to expand. Why? History tells us so. So history does not repeat itself, but it rhymes. As we go back through history here, we look at 2020, 2016, 2018, and all the times before. So again, above the 50, lose the 50, test the 200, get back above, expand. For how long? For 2 years. What happened in 2020? Lose the 50, lose the 200, reclaim the 50, expanded for 2 years, which is where we are now. Let's go back in time a little bit more. Why? Because this is so simple that I hope people are going to understand it. So back to 2016, right? Huge expansion for 5 years. We lose the 50, get below the lose the 50, test the 200, get back above the 50, expansion for another 3 years, right? Okay. So it seems pretty reliable. Keep that 2008 and 2000 in mind, though. So we look back to 2011 again, right? Lose the 50, test the 200, reclaim the 50, expand for 5 years, right? Huge move up. Now we look back to 2000 and 2008, which is what a lot of people are positioned for, whether or not it is actually giving us evidence. So again, here we have like the 1990 boom, where we go from 44 on SPY up to 140, or expanding by 300%. And then in times here, again, lose the 50, but don't actually test the 200. What happens? Expansion continues. Now we lose the 50 after the expansion's done. Test the 200, fail to reclaim the 50 once, fail to reclaim it twice. There's your negative 50% drop. That's the deep recession. Now we look at 2008. And ultimately, when we reclaim the 50, we actually start expanding again. And that is a 100% move, a doubling from the 2003 lows, the 2008 highs, 5 years of going up. Now, if you look at the 2008 crash, it's very similar. So we lose the 50, we test the 200s, and on the dead cat bounce, we fail to reclaim it once, fail to reclaim it twice, and then there is our negative 50% cut. So if we're not repeating what happened in 2000 and 2008, which were deep recessions, and the technical confirmation, is this time different? Well, everyone appears to think so because they are currently fighting the Fed. And with equal positioning on both sides, I don't know who's going to win. I'm happy to watch, and I'm happy to play the fallout because I don't think it's wise to try to make a huge prediction here. I think it's more wise to anticipate what's going to happen, but more importantly, react to the incoming data. So what we often say is that the news versus the reaction to the news. And what I would note regarding this news on Friday versus the reaction, I'll just go back to yesterday for the non-farm payroll. For me, again, what I would have expected is good news is bad news for stocks, and bad news is good news for stocks. So the bond market did what I wanted. The stock market did not. So that either means that the market no longer cares about, listening to the Fed, interpreting the data in a way that makes sense, but actually trying to fight the Fed, as I noted before. And the move that I got does not make sense to me. So what that means is that either bad news is good news and good news is good news, or there is a delayed effect where the market will drop, but it didn't do it on Friday. And there's more than one reason why that might happen, right? Options, manipulation, positioning, whatever. So now let's go through and try to understand how do we get to here? And with the evidence of fundamentals, where are we likely going to go? Before I forget too, we'll just quickly look at the options chains because people appear to love it when I do that. So let's have a look at these really fast here. And actually, I forgot one more thing I'll look at too before we look at the articles, because there's a really important distinction between the NASDAQ, the S&P, Bitcoin, and Ethereum, which I think are going to drive things for later. So here we can note that for Monday, there are fat stacks of puts, which means that the volume for Monday or the next options chain tells me that people think that what I think is going to happen is going to happen. They're looking at 412 down to 410, same levels I'm looking at. Over here, they're looking at 415 and 412. So again, that shows us that 412 is still the pivot, as those support and resistance levels from the weekly told us. So 412 would be max pain based on volume, not open interest. But it's just notable that, again, what I would expect to see on the options chain for positioning is kind of what I see there. Now let's look at Wednesday. So Wednesday the 10th, again, we're looking at SPY on the 16s. We can note that we got 413 down to 410. Pretty much the same with some down to 407. 407 is that weekly higher low that I mentioned. Over here, we got 412 to 415 and some up here at 420. Exactly what I would expect. So this is for CPI, and I'm seeing exactly what I would expect. Roughly equal positioning from both sides because we're unsure where we're going to go. So if we're unsure, we're going to see positioning from both sides, bull and bear. I'm looking forward to the 12th, which is going to be next Friday. What do we have? Well, we got a bigger stack at 410 puts. Same option starting at roughly 413 put and a little bit of open interest here at 410. Now we look at the call side. We got 412 again, all the way up to 415 with open interest, more than the put side. So that's actually going to give the bulls a notch. And then we got some 420 here, which for me kind of looks like a 415 to 420 call spread. So I don't know what's below here. I'm not looking below 407. I just like to look at the 16s, which is most probable. But again, I'm noticing here that there's more volume from the bears. I think there's an opportunity here, but there's more open interest or overnight. Again, confidence from the bulls. So again, also very mixed. So last thing we can do now is look forward to August 19th, which will be the monthly expiry for the month of August. And this is in roughly 2 weeks. Oops, the screenshot is going to exclude one of the numbers there. That's going to be in roughly 2 weeks. So next Friday. And what we're noticing here is, again, same levels. So what do we have? Well, there's tons of volume at 410. I'm confident that there's numbers going down to 400. But again, for the purposes here, we're not going to look at that. We focus on the 16s. The 16s just means 8 strikes below and 8 strikes above the current price. And right now, S&P is at 4134. So 413 is the center line. And then again, you can note that there's 8 above and 8 below. Just clarifying there in case people were wondering. So watching here, we note that, again, we got, where does it start? It starts at 410 with open interest, and it goes up to roughly 420. Okay, cool. So it's pretty much the same levels. Yeah, 420 puts, and there we go. More volume from the bulls, from the bears, but there's more open interest between 410, 415, and 420. All right, so with that out of the way, I want to point out one more thing here on weekly charts. So what I mentioned was that QQQ appears to be leading S&P. So again, QQQ is leading the S&P because it's already broken out, already backtested, and it's up more off the lows, roughly 20% off of those June lows. The S&P, in the meantime, is not. So I want to point out one key thing here. We're going to hide all the lines for now, and we're just going to look at where we are now versus where we were at the February and March lows. Maybe an easy way to look at this would be looking at the 3-month chart. So here we go. On the 3, I'm actually going to go to a clean one. What if I go to this one here? Anyways, we'll just go here. Just make it really simple. So if you look here, QQQ is now back above its January low, or its Q1 low. Now let's look at SPY. It's a little bit above, right? Not too much, though. It's actually, I need to look at the monthly chart, sorry. Because I'm looking at the... I'm actually going to go back to the weekly. Sorry for bouncing around. I'm trying to make sure I can tell the story in the easiest way. So let's hide the lines again. And now let's go back to QQQ. What I'm looking at here is going to be the February and March lows. And because this falls into Q1 and then Q2, it's kind of messing it up. So I'm looking at these lows right here. The line, which is dotted across, means that we're currently digesting the March and February lows right now. What's S&P doing? Well, it's not quite there. It's only testing the February low. It didn't quite make it to 415 or to 416. It kind of stalled out there. The high is 41568. So if the QQQs are still leading SPY, they have to take out these lows that we're noticing right here. So they did, right? On SPY, they're not. Those February, March lows are still unclaimed, where QQQ, as of this week, closed above all 3. They closed above all 3 of these ones right here. So as we hide those lines again, we're looking at 318, we're looking at 319, and we're looking at 317. Closing at 321, we took out all these relative lows. So QQQ has to lead. It has to power up. And a little bit later, we'll look at some of those trillion-dollar company charts. But now, anyways, the way I like to think about the NASDAQ and SPY is similar to the way I like to think about Ethereum and Bitcoin. So If QQQ was taking out its relative lows, but SPY is not quite yet, what it means is that QQQ is leading the S&P. If we now look at BTC, what's it doing here? Well, again, its most important relative low for me, or recent low, or local low, whatever you want to call it, is the red line at roughly 25,500. And we failed to claim it. We are above the 200 weekly, or the black line, but we're not above the red low. So again, why? Well, I think that because Ethereum has dropped off more, this one has to go first, which it's trying. So we note here that, again, we broke the downtrend, so downtrend's broken. And as of right now, we could backtest 1400, but we're not. Instead, we are actually powering up and currently above that low at 1701. So Ethereum could drag Bitcoin up, just like the NASDAQ could drag the S&P up. I'm watching these charts really close because they're important for risk appetite. One chart, just to keep the story going, is that I also, again, I shared this on Twitter, I think about 2 weeks ago. Here we are, right? We broke the downtrend, got a back test, and now we're breaking out. AMC is, again, a stock that is a meme, but it's up 50 on the week. It blew through its head and shoulders neckline. It's almost over its 50 MA, and it's just showing us that we have risk appetite coming back into the market. So now let's jump to some articles here and see if we can find some supporting evidence for what we see on the charts. So again, we're trying to do a postmortem here. There's an article that says, did Powell pivot? I think he did. So again, just looking here, getting to 3.4% this year is consistent with smaller increases. This is from Goldman Sachs. The 5 reasons why the chair's comments to think the Fed will now slow the pace of rate hikes. Right, he rated the official balance supply, but we're actually just going to skip this. It's again, pause the slide if you want to read it. Next article here talks about how investors shouldn't wait for the Fed to stop raising rates, as the stock market historically bottomed 6 months before the last hike. So again, looking here, we're talking about so getting to 3.4 this year is consistent with smaller increases. That's literally what this next article here says, and this is from Fundstrat. So that's Tom Lee over at Fundstrat. And then here we note, again, a projection from Goldman Sachs in terms of the rate of increase. And they're expecting that by December, we're going to be at the same rate we will be at in 23. And what month is it right now? It's August. What is 6 months from now, as the previous article says? It's January. So what does that mean? Well, if investors shouldn't wait for the Fed to stop raising rates, as the stock market historically bottomed 6 months before the last hike, well, the last hike is coming in December. That's less than 6 months away. Does that June low now make sense that, oh, well, if the last hike of the year is December, that's 6 months away. That could be the last hike, the end of the tightening cycle. All right. Also looking at the next one here, this is from last week. This is from Mohammed Al-Arian, and this one here is talking about how the Fed zip code for neutral is 50 basis points higher. So what does that mean? Well, 50 in September, and then they go into, moderately restrictive territory, which means a couple 25 basis point hikes, and then that's it. So there you go. This guy was also a big back critic of the Fed as well. The reason why this is also important is because as we look here to the FOMC meeting calendar in September, we're going to have a meeting on the 20th to 21st. So there's also an asterisk here, which is why there's those pink lines. It means that we're going to be provided with a summary of economic projections. And whether the market is aware of it or not, it wants to fight the Fed seems hell-bent on making sure that they go higher. And again, here is former New York Fed Governor Bill Dudley saying that the Fed will hike rates much further than the market expects. So what would that look like? Well, it would look like a rumbling on the 2- and 10-year Treasury note, as I've been trying to say, the red alert. So a 9% rip in a single day is huge. It's up 15 on the week. It is back. This is its highest weekly close, going all the way back to, oh man, this is a long time ago, 2008. That's a long time from now, right? That's more than a decade. You look at the 10-year note. It's not its strongest close, but that's because short-term interest rates are expected to go higher than the long-term ones. But a 5% rip is still huge. And that's why the yield curve inversion, or again, the 17%, 17.5% more interest you'll get on a short note than the long note is really concerning. Why? This guy used to be in the troika. He used to be the third most important person at the Fed. And because he no longer works there, he can speak his mind. He can say what he thinks. And what he's telling us is that there is a mispricing here. He tells us that Dudley says the Fed will hike rates much further than market expects. So the market is currently, again, fighting the Fed. And if there is a mispricing, that could have a negative, huge, again, overhang. Powell, June SEP, or Summary of Economic Projections, is the best guide. Shows 3.25 to 3.5% year-end rate. So if in September, as I noted before on the calendar here, they decide to update the Summary of Economic Projections to show that 3.25 to 3.5 is not high enough, what Dudley is saying is that the market is not expecting enough. They're going to have to go higher. Upside for markets very much capped, ex-New York Fed leader says. So that's really important. This guy used to be like, again, one of the most important bankers in the world. Then we look at Larry Summers, who, again, this guy has been very outspoken to the Fed, criticized Jerome Powell pretty deeply last week, and then his soldiers, again, all the FOMC members all came out and said, we're not a neutral, blah, blah, blah. And what Larry Summers here is concerned about is something that is very, very, very important. Another red alert. Why? He's talking here about how we're in an overheated state. The economy is overheated, and the Fed is saying we're at neutral. So if the economy is overheated and we're now seeing wage inflation, how are we going to lower it? I don't know. Here's an article which summarizes his thoughts a little bit better. There's the video if you want to watch it. It's roughly 10 minutes. Highly encourage you to do it. Summers warns Fed on 1970-style mistake with CPI set to slow. Former Treasury Secretary Lawrence Summers said he's concerned that a slowing in headline inflation in upcoming data will prompt the Fed to conclude its policies are working when much more action is in fact needed. So then we look to this next article here. What does it tell us? Well, the estimates are all decreases for CPI and PPI. So CPI is expected to come down. Core CPI expected to come down. PPI expected to come down. Isn't that what the market would want to go risk on even more? I think so. And as we look here, core CPI is already decreasing. So again, what he's saying here is that inflation is more entrenched than we thought. We got that confirmation with the employment number on Friday, but the market is discounting it. The bond market is like, whoa, red alert. So this is what's really concerning for me. We should be going down, but we're not. So there is something that is working underneath the market that we're maybe not sure about. And again, looking here, this is from, what day is this? This is from July 22nd, not that long ago, about 2 weeks. So Powell's key indicators shaping the Fed's rate path. If we're aware of what Jerome tracks, we should know how to interpret it, whether or not the market is currently accurate or irrational. Powell's favorite indicators include, again, economists say CPI and Michigan survey are favorite secondary reports after the PCE. So what comes out on Wednesday? It's the CPI. It's the second most important data print for the Fed, period. It is Powell's favorite indicator. Favorite indicator is going to be the CPI, and second favorite is going to be the Michigan survey. We're not going to get that one for, I think, another week or two. So this number on Wednesday is like kind of really important. It's really, really, really important. So here is a here's an excerpt from here. The Fed seems to pick and unpick economic indicators as if it was doing the weather forecast. We're a bit lost in the weeds when it comes to the understanding the Powell's Fed's reaction function, which is why, again, we look at that print that came in on Friday. The market's like, kumbaya, let's go up. When in reality, that's not what Jerome wants. He will lay the hammer down if he needs to. That's why all the Fed speakers were out this week. There's like 5 or 6 of them. One of the factors in her deciding to move ahead with 75, again, the 75 basis point hike in June went beyond Powell's guidance. So he's now pulled the guidance, but it just means that it's really hard to decipher what's going on. Again, another piece of evidence here is just that recession was now consensus, which means that everyone was expecting it. And now that we don't, that's the reason why the market's seeing relief. Why? Well, again, Jan Hatzius over at Goldman Sachs is telling us that it's a 1 in 3 chance of U.S. recession. So that is how the market got to here. Why? Well, people were not positioned for it. So they weren't positioned for this up move. And when it happened, they got caught offside. It's that simple. They were like, oh, it's a 100% chance of recession. Why? It's consensus. Everyone's like, it has to happen. And then when it doesn't, or it's not as bad, that's why we're seeing the reaction we are on the tape. So again, that's a repricing happening. So hedges are coming off. YOLO stock bulls say, wake me up when the Fed tightening starts to bite. So again, this is similar to there being those bulls who are stuck. As I can note here with, again, we can look at the short report. So the bears are stuck, and now, like I've said, the market's at neutral, and people want to start adding some risk on. Bitcoin up, right? AMC up. I would think it was AMDT or whatever was up like 18,000% this week or something. It was incredible. So all this means is that the bears are stuck, and the bulls want to start YOLOing again, right? You only live once, so that's what's really important here. The market is basically saying to the Fed, you're not going to have to go as far as you think you do, and also you might have to start reversing course much sooner than you think you have to. The market is dictating to the Fed. That is not how it works. You don't fight the Fed, and right now the market is kicking and screaming and fighting. Again, Katie Nixon, chief investor, CIO at Northern Trust Wealth Management, said in an interview on Bloomberg Radio, "Is it sustainable in the face of a Fed that appears to be hell-bent on not stopping? That's the big question. And as of right now, the market is discounting it. So we can understand the price action when we think about, well, what is the market telling us? Not what should it be doing? It's telling us you're not going to have to go as far as you think. You might have to start reversing course sooner than you think too. That's what it's telling us. Here's a follow-up. Again, what I mentioned at the beginning. That report brought signs of strong wage growth. From the report we saw on Friday, Trust's Nixon says that leveling off of some other inflation data is what's giving investors confidence to fight the Fed. And again, Larry Summers just said that's what he thinks is the red alert. So there we go. Looking at the next one here. Why would this matter? Well, again, this is from about 3 weeks ago. B of H survey shows full investor capitulation. Why? They're in full capitulation amid a dire economic outlook. Now it doesn't look so dire. So here's an excerpt. Global growth and profit expectations sank to an all-time low. Wow, recession expectations were at their highest since the P word fueled a slowdown in May 2020. Investor allocation to stocks plunged to levels not seen since 2008. Remember what I just showed you on the charts about 2008? While exposure to cash surged to the highest level since 2001. Remember what I showed you on the chart for 2001, those weekly moving averages. According to the survey, a net 58% of fund managers said they're taking lower than normal risks, a record that surpassed the survey's global financial crisis. So what does that mean? It means people are scared right now. They're scaredy pants. And if your goal is to beat the market and the market's going up, you have to start chasing it, which means there's a lot of opportunity to get trapped on either side. Now we can look at how the S&P earnings are shaking out. They're almost done. There's a couple this week, but for the large part, S&P is done. And we have 75% of S&P 500 companies beat on EPS. Again, which is the lowest since Q1 of 2020, but 3 out of 4 companies beat. That's pretty impressive. Right, financials, consumer services, consumer discretionary are the ones that miss the most. Energy, technology, healthcare, industrials, real estate, S&P overall are the strongest ones. What are those? Leaders. We can also note, again, this is a strong short squeeze. Why? Well, we noted it. That's a strong number. It's flexing. It's really showing it's strong. Now let's look at some individual investors to try to get a grasp on the psychology of what could be happening on the charts. So Tiger Cubs stung by market rout, dumped stocks, then missed rally. Oh man, these guys look like losers. They're supposed to be professional money managers. How much did they lose? Only half their money. They lost half their fund, or billions of dollars, in the last 7 months. So the Tiger Cubs are a group of traders that are part of Tiger Global. And again, they include Cotu, Tiger Grand Cub D1, and others. So Tiger Cubs stung. And again, they failed to cash in on the S&P's biggest month since 2020. Man, they kind of look like losers, right? Why would you want to pay them to manage your money? D1 had net exposure to equities of just 9.5% at the end of June. They got record cash. Looking at the next one here, again, another fund. Cotu had reduced net exposure of its hedge fund to 14% from about 60% a year before, according to blah, blah, blah. It also is sitting on more than 80% cash. Why? They've lost so much that now they want to play defense, not offense. They're not alone, though. Again, an analysis of 130 stock-picking hedge funds show they cut their aggregate exposure to the S&P by about a third between February and July. They're raising a whole bunch of cash, which is how we see that capitulation happening. Again, so they're deep red so far this year. Tiger's hedge fund tumbled 49.8%. They've lost half their money. That's incredible. They underperformed the market by 3 times. Market's down roughly 13, I think. And they're down by 50. That's huge. Here's Here we go, right? In a May investor presentation, which is when they were all liquidating, they said they went to cash for peace of mind, telling clients, our job is now to figure out when and how to start playing offense, which they have not. Why? They didn't get any money so far this month in July. They eked out like 1%. Why? They were basically net short and long to net out to zero with too much cash. Moving forward here now. So again, most companies have beats. Now they have to chase it. And the reason why I believe more people are still on the sidelines is because there's a wall of doubt or a wall of worry. So, oh my God, we got through the last set of worries, but now we got more worries. We got recession risk. We got inflation. We got the strong dollar. We got Fed hikes. We got earnings revisions. And we got geopolitical tension. And that's why we're seeing, huge short positions like we've not seen since about 2016. And what happened in 2016? I showed you. We ripped higher for years. That's what happened. Short squeeze, 2016 to 2018. And we also note that, again, the market is currently discounting. Here again, we have the Fed funds futures, which is going to be the blue line, but we have the FOMC dot median, which is going to be the green line. And we're expecting that, as we noted before, the market is telling the Fed, you're not going to go as high as you think you need to, and you're going to start cutting sooner than you think. That's what the market is doing. Whether or not it's correct, I don't know. Looking to the next thing here, it tells us that investors are going to continue to be frustrated this year. Are you frustrated? I know I am. All right, one more thing here. Again, we talked about Taiwan. I'm only going to touch on this briefly because I think that this is important. You have to remember that there is an election in the fall in both of the world's biggest economies, and they have to think about image. They have to think about how they are presenting their story. And as we look here, sweeping mortgage boycott changes the face of dissent in China. Angry home buyers have launched one of the most effective protests the country has ever seen. Why? People are pissed off. They've given money to build houses, and then they're not getting built. I'd be pissed off too. In a country that does not like any dissent or anyone saying what they're doing is not good, this is extremely notable. So does that kind of make sense in the reason why we're seeing more being done by China in terms of Taiwan? I think so. Taiwan says China's simulating attack on main island in drills. Okay, why would they do that? Here's a quote. Nothing brings you together like a common enemy. So going into election season, what happened? Well, in America, they're trying to, again, rally up against a common enemy. Who is who? The country we just talked about. On the flip side, there's also an election happening in that country. What are they doing? They're saying it's the other team's fault. Hey, as bad as things are right now with your houses and your mortgage and stuff, we have to rally together to fight this enemy who is trying to hurt us. That's the story I think is happening. The rhetoric is ratcheting up. And I see that here because as we look to our next tweet here again, China's senior diplomat Wang Yi, we need to issue a warning to the U.S. U.S. should not act rashly. U.S. had not better create a bigger crisis. Again, what are they doing? They're doing this right here. Don't poke the bear, or poke the rising dragon, as they like to be called lately. Chinese official in U.S. Says the only way out of this crisis is for U.S. side to immediately rectify mistakes. What are they saying? It's your fault. You're our enemy. It's not our problem. And China's really good at doing this. They make their problem into an external issue, right? What happened in 2020? What's happening now? They blame the rest of the world. No surprise they're doing it again here. So again, also looking at the fear and greed, we note that it's right in the middle, right at neutral. So that is why I believe we're currently seeing those muted reactions, but eventually the coil will release, and we're going to get that explosive move. We already talked about the key events for the week. There are some earnings, but to be honest, none of them really matter. Coinbase, Roblox, sure. Upstart, maybe. Disney would actually be one I would watch for, but otherwise, I don't really care. All the big guys are out. We already talked about key dates. We talked about why bull or bear. And we also talked about how we usually go almost nowhere for the year. So video's a little bit longer than I normally would want, but I think that I did a great job of trying to present the balanced view for both the bull and bear case this week. I'm going to finish off by just looking at a few charts here. Again, we talked about the NASDAQ or the Qs versus SPY, and we talked about BTC versus ETH in that same respect. We also talked about how the 2 and 10-year note are ripping to new all-time highs in terms of inversion. The 2-year note has its strongest weekly close in more than 10 years. The 10-year note ripped up 5% on Friday. The VIX is down, which means fear is down for multiple weeks in a row ever since the June low. Dollar broke out. above 106.56, big area. And now we're going to look at the trillion-dollar company to know whether or not this pivot on the NASDAQ is going to either go into bull market territory or get back above 323, or if we're going to reject somewhere between here and 327 and get our back test to form a cup and handle. We could also have a W in the making here, which again would lead us to retesting the highs at roughly 370, and that is the bull case, reclaiming the 50 and going to highs. All right, so now let's look at Apple, Microsoft, Google, Amazon, Tesla, NVIDIA, and Meta. What does Apple have here? Falling wedge breakout, nonstop up ever since earnings, over the 50, bullish. Also outside the yellow box, also bullish. Volume is not there though, it's dropping off. Microsoft, head and shoulders to a channel lower, or the blue lines. It broke out, took out the pink line or the key pivot. It's also above those February and March lows. What is Microsoft doing? It's trying to lead, and it's back tested and held the pink line at roughly 270. Looking at Google, very similar, right? Just like Microsoft. So we have that falling channel here, and now we actually are poking out of the downtrend. What does that mean? We stop going down. We can start going up. I would look for those February, March lows of roughly 126 to get tested. Amazon, again, there's the February, March lows. Where are we? Interesting. We're testing them. Big move higher after earnings, massive hole or gap on the daily chart, and awfully close to that 50 DMA. Really close to the red line too, which is resistance. Almost wants to start going. Tesla, big reversal on Friday, down 6%, but only down about 3% on the week. It's also outside of the head and shoulders pocket or the yellow box, but it closed about $10 back inside. If it can reclaim, the 50 weekly at about 882 on a closing basis, I would say that Tesla is ready to lead, not just hover. As of right now, it's trying to lead, just needs the confirmation. NVIDIA, lots more to get back. Again, February, March lows are all the way back here at about 210. Needs about another 10% to get there, but it's been going up, and the volume is actually elevated compared to its normal period here. So NVIDIA looks like it wants to go too. Meta, this company just stinks, right? Facebook, Meta, whatever you want to call it, it's a stinky company, and there is potential for it to outperform, or expectations are so low that anything can make it go up. It's currently inside the yellow box. It's just inside of it, which means it could shoot back up. It could also reject to start going back lower. So without taking up too much more time, it appears like the NASDAQ is building up steam, and the biggest companies in the market are ready to start going. So will the QQQ continue to go higher, or are we going to start to find some resistance and start to sell off? If you enjoyed this weekend's video, I would really appreciate a thumbs up. If you could please drop me a comment. And if you enjoyed the video, we put out videos every single day. If you could subscribe to the channel, that'd be appreciated. And if not, there will be a video here that queues up, which showed you the reason why I got bullish into here. So we can go back in time to see whether what we predicted before happened and whether what we're predicting now is likely to happen. Thank you for watching. Look forward to seeing you on Monday.